TJX has beat the market, returning 42% to shareholders in the last year alone, but can they keep this market-beating performance up? We're analyzing the TJX Companies Inc., stock ticker TJX, to see if their market price is a fair value. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for TJX. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing TJX for your portfolio. Before we get into these valuable metrics, let's understand TJX's stock performance. Right now, TJX trades for $78.22 per share. In the last year, their stock price is up 41%. The company pays about a 1.5% dividend yield, which are in addition to their returns in their stock price. In the last 5 years, TJX is compounding at 12.5% annually. In the last 10 years, they're compounding at about 12% annually. Going back prior to the global financial crisis, in the last 18 years, TJX compounds at about 15% annually. The company's stock price is up more than 12 times over this period. Their average annual dividend yield is in addition to these compounded returns. TJX trades just $5 below their 52-week high. The company is up more than $20 from their 52-week low. Very few of their shares are sold short. TJX is a very large business. They have a $91 billion market cap. But why should we really be paying close attention to TJX? TJX is a leading off-price retailer of apparel, home fashions, and other merchandise. It sells a variety of branded goods, opportunistically buying inventory from a network of over 21,000 vendors worldwide. TJX targets undercutting conventional retailers' regular prices by 20 to 60%, capitalizing on a flexible merchandising network, low-frill stores, and a treasure hunt shopping experience to drive margins and inventory turnover. TJX derives 77% of fiscal 2023 revenue from the United States, with 12% coming from Europe, 10% from Canada, and the remainder from Australia. The company operated more than 4,800 stores at the end of fiscal 2023 under the TJ Maxx, TK Maxx, Marshalls, HomeGoods, Winners, HomeSense, and Sierra banners. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. There are 2 key reasons for this. The average publicly listed business earns about a 7% return on capital. Looking for a benchmark that's double this allows us to build in margin of safety for ourselves based off the overall quality of the business being about twice as good as average. Over the long run, over the course of decades, a stock's likely to return what its underlying business returns. These business returns are captured by return on capital. TJX saw quite the swing in their returns on capital throughout this time. They were already declining coming into 2020. In the company's fiscal 2021, the company saw very anemic returns on capital. Since then, things have rebounded for TJX. They earned 25% returns on capital in their most recent fiscal year. Averaged out during this time, even with the company's rough showing in 2020, TJX earns about 26.5% average returns on capital. Those are nearly 3.5 times better than a typical business. This is a big check on metric number 1. Metric number 2, we're looking at the company's growth. We want 5-year growth in their revenues, net incomes, and free cash flows. All of these have to be up for this to be a check. This metric's all or nothing. We'll be including their last 12 months worth of numbers in our calculations. Taking this high level really shows how the business was hit in their fiscal 2021. When their revenues and their net incomes came cratering, the company did have strong free cash flows in all 5 of these years. During this time, TJX grew their revenues by 28%. Their earnings are up 14%. However, their free cash flows, while positive in all 5 years, are down slightly. They're down about 11% overall. Because their free cash flows are down, this is an X on metric number 2. This isn't the end of the world. Free cash flows can be lumpy year to year. It's great to see, though, that the business had positive free cash flows in such a tough economic circumstance for the company during 2020. Metric number 3, we're taking the perspective of an individual shareholder by looking for earnings per share growth in the last 5 years. During this time, we've already learned TJX has grown their earnings by 14%. The company's also bought back about 6% of their shares outstanding, which is important because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. When a company buys back its shares by decreasing the number they have outstanding, they're increasing your ownership percentage in the business without you having to spend a dime. It's almost like the company's making making a partial acquisition of itself. Just like with any acquisition, we want the business to be getting more value than the price they're paying. This depends on a couple factors, including the price these buybacks occurred at and what the intrinsic value of the company will be, which we'll estimate later on in our video. So stay tuned. Because of their earnings growth and their share buybacks, this is a check on metric number 3. Metric number 4, we're looking for free cash flow per share growth in the last 5 years for TJX. Even with their slight buybacks, their declines in their free cash flows will outpace this. Their free cash flows per share are down over this time just slightly. This is an X on metric number 4. Recapping where we stand currently, we're split evenly through our first 4 metrics. We have 2 checks and 2 X's for TJX. During economic downturns, it's overly levered businesses that are at the greatest risks of poor outcomes. In metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow TJX has produced in their last 5 years. Right now, TJX has $7.3 billion worth of net debt. In the last 5 years, the company has produced $14.4 billion worth of free cash flow. They've been free cash flow positive in all 5 of these years. Even though their free cash flows are slightly down, their free cash flow production is nearly double their net debt usage. This is a big check on metric number 5. The business's balance sheet looks like it's in a healthy position, that their free cash flows would support their debt loads. The company's produced $2.6 billion worth of free cash flow in their most recent fiscal year. Now that we've looked at the company's debt, it's time for our bonus. As our bonus, we're looking at TJX's dividend profile. TJX currently pays a 1.5% dividend yield. We're looking to see if this is supported by their cash flows. TJX has moderated their dividend throughout this time. They slashed their dividend in their fiscal 2021, but have been increasing it by quite a bit since. In all 5 of these years, TJX has comfortably supported their dividend payouts using their cash flows, and they've been aggressive returning capital to shareholders since 2021. While this is a snapshot of their last 5 years of performance and it's no guarantee for the future, it would seem like TJX has done a good job of covering their dividends using their free cash flows, and that's the case currently. The big metric of them all, metric number 6, we want TJX's average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this provides a slight risk premium to the yield of the 10-year treasury. It may offer a reasonable starting point for a valuation of TJX. Right now, TJX has a $98.5 billion total enterprise value, taking into account both their market cap and their net debt position. This gives a perspective of TJX similar to it being a private company. In the last 5 years, we learned the company produced $14.4 billion in free cash flow, meaning in an average year, they produce about $2.9 billion in free cash flow. When that's divided by their $98.5 billion total enterprise value, we get just under a 3% average free cash flow to enterprise value yield. In their most recent fiscal year, the company produced $2.6 billion of free cash flow. When that's divided by their total enterprise value, that gives about a 2.7% current free cash flow to enterprise value yield. Both of those are coming in below the yield of the 10-year treasury. They're well below the risk premium we'd be seeking, meaning this is an X on metric number 6 for TJX, but don't throw this business out. There's still work to do as we come to a concrete estimate for their fair intrinsic value before giving our final rating to the business. Everything we've discussed so far is important, but there's still something missing that, in my opinion, is the main reason to analyze TJX, which takes us on to using a discounted cash flow model to come to an estimate of their fair intrinsic value. A DCF model is based off the predictability of a company's free cash flows. TJX has not been a very predictable business in its past. Like any model in any discipline, a DCF model's outputs are sensitive to its inputs. We're starting with the company's current free cash flows and using historical growth assumptions to grow those into the future. It's up to you to do your own homework to figure out if these are accurate and applicable for the company going forward. Assuming they grow their cash flows at about 7% annually for the next decade, then assuming their cash flows grow at 4% annually in the decade from there, if we add in an estimate of the company's tangible book value, which gives us an estimate of their net worth, this is skewed based off how the accounting is done for the company's share buybacks, so this likely underestimates their tangible book value. If we're seeking a 15% rate of return, which is the rate of return Warren Buffett's looking for from his investments, in addition to his margin of safety requirements, from today's valuations of TJX, it looks like a fair estimate for their intrinsic value is only around $28 per share. That's down $50 from the company's current stock price. That's pretty significant. There are the key factors you'll want to be mindful of. TJX has not been very predictable profitable in its past, especially in the last handful of years, because of how the business was impacted by lockdowns in 2020. So that's something you'll want to be mindful of, especially as the company is a retailer. The 15% discount rate we're using is an estimate of total returns to shareholders. This would already be including the company's 1.5% dividend yield. Again, some of these assumptions may be skewed based off recent events for the company and how the accounting's done for their share buybacks. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before considering any investment decision. In just a moment, we'll give our final rating to TJX, but we have to address something first. We focused a lot on the numbers, but what are the qualitative aspects of the business that set TJX apart? Starting with the qualitative factors supporting a potential long thesis. Number one, TJX's international operations should offer ample runway for growth and associated incremental cost leverage, with the store banners and off-price concept translating well abroad. Number two, it's believed digital retailers will have a more difficult time encroaching on the off-price channel, considering the sector's already low prices and vendors' demand for discretion. Number three, with an agile merchandising and distribution network, TJX keeps inventory fresh, spurring traffic and minimizing risks associated with fashion trends and freeing up capital. Then the qualitative factors supporting a potential short thesis. Number one, digital retailers have struggled to usurp TJX's off-price strength, but their efforts to build cost leverage, ease returns, and price even more aggressively could create strain, and their adoption could have been accelerated. Number two, competition in retail is fierce, necessitating continued investment in the stores and low prices to maintain traffic. Number three, inflation and economic uncertainty pose many near-term challenges as TJX works to navigate shifting spending patterns. There you have it for a balanced perspective of some of the qualitative elements of TJX. Now it's time for our rating. In analyzing TJX, we learned the company earns 3.5 times above average returns on capital of nearly 26.5% annually. They've grown their revenues and their earnings and even bought back 6% of their shares in the last 5 years, but their free cash flows are slightly down over this time. Even with those declines, the company is easily able to support their net debt position. On both a current and an average basis of their free cash flow to their enterprise value yields, those were coming in at about half of the risk premium we'd be seeking, and they were well below the yield of the 10-year treasury. While TJX has shifted its dividend payouts in the last 5 years, dramatically cutting these in 2021, the company's been able to support them with their free cash flows in all 5 years, and they've increased them quite a bit in their last 2 fiscal years. It's worth reiterating this analysis is not financial advice. When we performed our discounted cash flow analysis, if you've done the work and you believe those historical growth assumptions, from today's valuations, if you're seeking a 15% rate of return for TJX, an estimate of a fair value for the company is around $28 per share. TJX was last at those levels in August of 2014. Keep in mind the caveats we mentioned. Combining all the factors for analysis together, TJX looks like a moderate candidate for further research. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to look at next time. Thanks for learning about TJX with me, and have a great day.